Before we start today's episode, I need 10 seconds of your attention. Over 50% of the people who watch this channel regularly haven't subscribed yet. And the truth is, subscribing is the single free way you can support the work that we are building here. And in return, this is my commitment to you that I will bring clarity, I'll bring depth, I'll bring value like never before. We have got so many things planned ahead. We have got masterclasses coming. We have got guests and industry voices and leaders coming up. And the conversations that uh, are coming up are designed to transform how you think about money, investing, and wealth building in Kenya and beyond. So, before we begin today's episode, I want you to scroll down, hit the red subscribe button, and turn on the notification. You do this so that you don't miss a single insight, so that you never miss a special moment that you might be looking for. Now, let's get into today's episode. If you're a beginner investor in Kenya, your biggest fear is probably not returns. It's actually not returns. It's losing money. You don't want to lose money. Why? This is because investing is a game. I've always said that investing is a game. And once you lose money, you are literally out of the game and you never have a comeback. In 2026, there's economic uncertainty. We have got rising costs of living. We have got countless investment opportunities that will promise you unrealistic returns. Uh, with all those things in mind, safety must always come first, especially when you are just starting out. So, in this video, what I'll do, I'm going to break down the top 5 best and safest investments in Kenya for beginners in 2026 and beyond. And I'm going to rank this one from the highest risk to the lowest risk, which is also the safest. Now, I've gone ahead and done something special. For each investment, I will explain 5 things. The first one, why it's considered to be safe or safer. The second one, its safety score from on a scale of 1 to 5, and I'll demonstrate that using this. The third thing, we shall look at the average performance over the last 3 years. The fourth thing, we shall look at whether people have lost money before in that particular investment. Then the last one, we shall look at how to start investing the smart way in that particular investment. So let's start by defining, so that we are on the same script. Let's start by defining what safe actually means when it comes to investing. Now, whenever we say an investment is safe, we are not saying it has got zero risk, because any investment has got some level of risks involved. If anyone or any company tells you that or of an investment that has got no risk, they are lying to you and it's likely to be a scam. How did I arrive at the safety factors? I looked at 5 factors that you have to consider. Number 1 factor is capital preservation. This is a self-explanatory term, which means what is the likelihood of you getting your original money back? Factor number 2, stability of returns. How predictable is the income from that particular investment? Factor number 3, regulation and oversight. Is whatever investment we are talking about regulated by Capital Markets Authority, SASRA, Central Bank of Kenya, or government backing? Factor number 4, liquidity. How easily can you access your money? And then factor number 5, track record. How has that particular investment performed across economic cycles for the last 3 to 5 years? Now, using these 5 factors, let us now rank the investments from the highest risk to the safest. Investment number 6, I've got a bonus. They're supposed to be 5, but I've got a bonus. So investment number 6, we have got it right here. Is the, I hope you can see, is the Nairobi Securities Exchange. What does this mean? When you invest in NSE, what you are literally doing, you are buying ownership shares in a large corporation or in a large established company, those that are in Kenya. Look at the likes of Safaricom, look at the likes of EABL, look at the likes of Kakuzi, just to mention those companies that are listed on the stock market. Now, we are saying that stocks represent ownership in companies, and company performance can fluctuate due to the factors such as economic conditions, management decisions, and market sentiment. So the price of shares can fluctuate depending on the factors that are either internal inside the company or external factor that the company doesn't have any control. Even strong companies experience price swings from one time to another. Now, what is the safety score? In my allocation, stocks, we have a score of 3 out of 5. This side is the more riskier, this side is the less riskier. So we move along this scale. So NSE, we put it at 3 over 5. Let's look at the average performance for the last 3 years. Averagely, they have paid dividends of between 8% and 15% of your investment. It's highly dependable on the stock selection and holding period. Those are the two factors that will determine how you get your returns from stock exchange. Now, have people ever lost money? Yes. Why? People have lost money due to panic selling, due to speculation, and due to short-term trading. How do you start? For beginners, stocks should be approached slowly and selectively. Don't buy stocks emotionally. Don't buy stocks because you love Safaricom or because you love Airtel or because you love a particular bank. So approach it slowly but selectively at the same time. Let's go to investment number 5. And this, we have got the special fund. Special fund. What is a special fund? Special funds are professionally managed collective investment funds that are designed for a specific goal. Some of the goals for special funds are the following: capital protection, income generation, and balanced growth. They often combine the following. Special funds always combine the following. They combine treasury securities. This is where investments are made. Your money in special funds, this is where it's invested. Treasury securities, high quality bonds, money market instruments, and sometimes limited equity exposure. Now, all of them are regulated by Capital Markets Authority. Now, let's look at the safety score. The safety score for special funds is a 3.5 out of 5. Let's look at the average performance for the last 3 years. They have averaged between 7% to 11%, depending on the type of the fund. Remember, there are different types of special funds. We've done a video on them. I'll have it attached either up here or up here. Now, have people ever lost money? Rarely, but it's very possible. Why? People have lost. It's possible because market fluctuations. There are factors that are beyond the company control. So these make the market to fluctuate, and therefore people are bound to lose money. But it has not happened, but it's a possible scenario. Now, losses are usually temporary, but not permanent. For anyone to begin, what do you do? For beginners who want hands-off. These ones are ideal for beginners who want hands-off investing with moderate risk. So for anyone to begin, start with doing a deep research on the best special funds that are available. Check the regulations, check the payout, and then make a rational decision. Let us go to investment number 4, and this one is, I call it the rates. I hope you can see that, the rates. This is real estate investment trust fund. Let's start by understanding what it is. When you invest in rates, you are investing in income generating property through the stock market without necessarily buying or managing a property, buying or managing a physical property yourself. Now, coming at number 4, why are rates safer than physical property? Rates are safer because they allow you to invest in property without, number 1, buying land, which has got risks attached to it. Number 2, managing tenants, which is a headache and has got risks involved. Number 3, raising millions in capital, which is sometimes difficult when you want to do a physical property on your own. Now, rates are professionally managed by managers, they are diversified, and then they are capital markets authority regulated. Let's look at the safety score. We gave them a 3.8 out of a 5. Why? Because they have been paying relatively well and they are stable. They approximately pay between 7% to 10%, mostly from rental income. Have people lost money in rates? Yes. Why? Due to volatility, fluctuation in the market. Yes, but rarely. You rarely lose the total money because the market can fluctuate, and so the amount of investment that you made vis-a-vis the amount of income that you get just becomes a little bit. So you don't lose all the money, you lose a little bit due to market volatility or price volatility. Now, the risks is normally lower as compared to owning a single physical property. That being said, let us move to the investment number 3. These are the, here they are, we have got the Saccos. Saccos. What are Saccos? We have talked about Saccos before. Saccos are member-owned financial cooperatives where you earn dividends by saving and lending money collectively as a community. This can be communities of workers, people working in the same under the same employer, or people from the same locality. We have got circles for teachers, circles for police, circles for people in banks. We have got circles for people in a particular location. Why Saccos rank higher in safety? Saccos rank higher in safety because of, number 1, Saccos are fully regulated by SASRA. Number 2, Saccos are backed by member savings. And then number 3, Saccos are built on long-term participation and not just speculation. But it goes without saying that there are Saccos that people have lost money in their Saccos, but this is majorly due to mismanagement by the management. We'll talk about that. Returns from Saccos, they come from 2 ways. Number 1, annual dividends, and number 2, interest on member loans. Safety score. Saccos, we give it a 4 out of a 5. A 4 out of a 5. How have Saccos performed in the last 3 years? Averagely, Saccos have paid a dividends ranging between 8% to 14% per annum. But it goes without saying that there are other Saccos that have paid relatively well. There are Saccos that have paid 15, 16, 17, all the way up to 18% in dividends. Have people lost money in Saccos? Yes, but mainly in, number 1, poorly governed Saccos. poorly managed Saccos, and unregulated Saccos. So when investing in Saccos, what do? Stick to large Saccos, stick to audited Saccos, and stick to long-standing and serving Saccos. Let's move to number two, investment number two, and we have got, this is a common one, we all know what it is the money market funds. What are they? We've done videos on money market funds. I'll have them attached up here. Now, so money market funds are low risk investment funds that is normally a pool that are pulled together, and they earn interest by investing where? In short-term government and bank securities. Why do money market funds matter? The first major reason why money market funds matter is because money market funds are very liquid, extremely liquid, meaning that anytime you want to get your money, you can get your money out immediately. Number two, money market funds are regulated by Capital Markets Authority, and this adds a level of security to your investment. Number three, money market funds are ideal for emergency funds. Number four, they are used by beginners and institutions alike. Any person who is being employed, they know about money market funds. Safety score. Money market funds have got a score of 4.5 out of 5. Why? Because we've talked about they are fully regulated. How has money market funds performed in the last 3 years? Money market funds have averaged between 8% to 11% annual returns, but this one is calculated to a daily returns, and money is paid to you on a daily basis. Have people lost money in money market fund? Very, very rare. For many beginners, this is normally their first investment that they should or they can ever make, because of the liquidity, because of the safety, and because of the layers of security that are found. Now we go to number one. Whoever sits at position one is Treasury bills and Treasury bonds. This is one of the safest investments for any potential beginner. Why is it safe? This one is safe because you are lending money to the Kenyan government in exchange for a guaranteed interest over a fixed period of time. It's worth noting that the interest is always guaranteed because the interest is predetermined at the time of auction. So when you're investing 100,000 at 15%, the 15% interest rate is predetermined at the time of auction. That's why we say that the interest is guaranteed over a fixed period of time. Now, let's get to understand the difference between Treasury bills and Treasury bonds, but I've done a video on all of them. I'll attach it here, either up here or up here. Now, Treasury bills are short-term and Treasury bonds are long-term. That's the basic difference between the two. Now, bills are short-term government investments that can come in 91 days, 3 months, 182 days, 6 months, or 364/5 days, 1 year. Treasury bonds, these ones are long-term government investments ranging from between 1 year all the way up to 30 years. The most important question, why are they the safest and the best? This one is the safest and the best because when you buy Treasury bills or bonds, you are lending money to the Kenyan government, and the government will always be there, whether today or tomorrow, the government will always be there. And the Kenyan government, number one, has never defaulted on local debt. Number two, has taxation power. Number three, is the most regulated borrower in the country. Number four, the government controls monetary policy through Central Bank of Kenya. This reduces the default risk. And then number five, the government always backs these instruments with the full faith and credit of the state. And this makes them legally enforceable. Safety score, you got it right, 5 out of 5 when it comes to safety. How have bonds and bills performed in the last 3 years. Treasury bills have averaged between 9% and 12%, while Treasury bonds have averaged between 11% to 15%. Remember, these values can go high up to around 16, sometimes 17%, but for the last 3 years, those ones are the average rate. The most important question: have people lost money in bills and bonds? No loss of principal if your money is held to maturity. This is the gold standard of safety in Kenya. Now, let's look at the safety strategy most beginners ignore. When you talk about safety, the best strategy when it comes to preserving your capital comes down to one thing: diversification. This is the safest investment strategy, is to diversify your income. Is At the end of the day, it's not about investing in one vehicle, but diversifying your income in different assets. You mix a different investment so that to give you a buffer whenever one investment doesn't perform well. So, example, do this. If put some money in money market fund for liquidity, if or emergency. Put some money in treasury bills or bonds for stability. Put some money in a Sacco for constant income, constant income, and then have some money in strong stocks for growth. The guideline for investing: when you want to start investing, number one, start with safety. Safety is paramount, not excitement. Step number two, invest only through regulated institutions. Step number three, begin small but stay consistent over time. Step number four, diversify across several levels against several safety levels. Number four, think long term. Investment is a long term game, but long term is normally boring, but boring is good. So, steps to start investing. Step number one, build an emergency fund. Why? Because you don't want to pick your money from an investment to go and attend to an emergency. That's why it's always advisable have a buffer money in a money market fund, which acts as an emergency. Step number two, you start small. People get it wrong, thinking that you need 1 million to start investing. No, the thing is you need just to start small, and eventually consistency will build up. Step number three, use regulated platforms only. Check Capital Markets Authority, Central Bank of Kenya, and SASRA registration. Step number four, the last one, avoid too good to be true returns or promises. If someone or a company promises you high returns plus guaranteed, that is equals to a scam, more likely to be a lie. If a company tells that they will give you returns of 30%, 28%, and it's guaranteed, that's a red flag. As we close, if you're a beginner, your goal is not to get rich fast. Your goal is to protect your capital preservation. Your goal is to build confidence when it comes to investing, and finally, learn how money really works, compound interest, when it comes to investing. So if you found this video helpful and valuable, like it, subscribe, and I'll see you in the next one.